presentation for about an hour, and then we shall have a Q&A session. But you can write your questions directly in the chat, and we will try to summarize them, and then our presenters will answer them. A recording of the webinar and the presentation will be added to the EMEA website within a couple of days. And if anybody needs an attendance certificate for SPD or IDD purposes, please contact myself or my colleague Stefan Jocelyn. With this, I'm finishing with this small introduction and handing over to Stephen.
Thank you very much, Marina, for those kind introductory words. I appreciate, Steve and I appreciate the opportunity to present to this important group, EMEA, this interesting subject and sometimes challenging subject of ours, DSU. Stephen, could you just change the slide, please? So we propose this morning or this afternoon, depending on your time zone, a sort of three-part presentation. It was Stefan Lammel of Munich Re, I think your chairman of EMEA, approached me via the Institute of London just around the time the book was launched in early December last year. And I think it's appropriate then to spend some time, but not a lot, just sharing with you why the new book was written, how we went about writing it, who wrote it, who is aimed at, the audience. It's not just for underwriters or even brokers, but a whole gambit of people. It covers both EAR and CAR, onshore and offshore, and indeed the important subject of marine cargo, because until cargo arrives on our project sites, nothing really can get started. The book is available in hard copy and electronic version. When you buy the book from the Institute, you get both hard copy and PDF version. This is not a sales pitch for the book by any means, but of course, the more interest that's shown in this book, the happier the likes of Stephen and myself are, although we gain no financial benefit from the number of sales. The part two, I think, is a more substantive part of our presentation to you, is about DSU itself. So we're going to draw on some of the things that came out in writing the book and are included in the book at various levels. So the book's aimed at people with varying levels of experience. The co-authors and the Insurance Institute felt that there was a continuing lack of proper knowledge of DSU in the market, and indeed some people with quite wide experience had some misconceptions and false understandings of how it works or how it doesn't work, and we try to put that right through the medium of this book. So just very quickly, our agenda will be, I think it's very important to have a good understanding of the general principles of business interruption or consequential loss insurance. To have spent time in that class of insurance, perhaps on operational risk, is a great step forward in grasping the elements of DSU. But we'll then go to a basic outline of the what is DSU, what is the product, what coverage features in it, how can it be extended, broadened. Then the third bullet here, the analysis of delay. This is going to be where Stephen Horn takes control. There's a lot to be said about this, and I think whether we're an underwriter or a broker or anybody else involved on the fringes of this business, there's a lot to be learned from this section of the book and what Stephen has to say, and I'll leave it at that. But then we're going to move back to some more specific DSU issues, which are challenging or commonly encountered, which are sort of highlighted here, and I'm going to go into these towards the end of our presentation in some detail. So ambiguous wordings, I underscore the word onshore because it's mostly the onshore EAR, CAR wordings where we found, as a group of authors, there were poor definitions, contradictory definitions in the same policy, unclear application of exclusions and clauses and the like, and we're going to talk about that a bit more. Increased cost of working is a vital part of any business interruption cover, and it's equally so in terms of DSU, although it presents quite different risks to those providing ICAW cover or those seeking to benefit from it. And I want to spend a few moments discussing those differences. Then a new feature of the book was some discussion about what I call qualified policy exclusions. And defects in their various forms is an illustration where we discuss to what extent does DSU respond to a policy exclusion where it's not an absolute exclusion, it allows some coverage back in, and we want to see how that plays out, not only in the material damage terms, but also in terms of the resultant DSU claim. There's something to be said about how marine and non-marine coverages interface with each other when one stops and the other one starts, how losses may be shared if it's unclear when damage actually arose between the transit and the on-site risk policy. We will discuss periods of extension, extensions to the period of cover, which commonly arise either due to general delays in the construction program or erection program, or indeed following a potential claim where something has happened on the site and the insured faces a decision whether to extend the period or not. Then just a few words at the end about customers and suppliers extensions. Again, a common extension to a standard business interruption policy, but it has a different dimension to it when talking about DSU. And lastly, before we move on to the Q&A session, which Marina mentioned, something about the provision of capacity to the worldwide markets. These DSU exposures often relate to large risks. The DSU exposure aggregates directly with the material damage risk, and it requires significant capacity in many infrastructure and large-scale projects. And there's something to be said about some reinsurance issues that may arise. So as Marina said, we'd prefer to take questions at the end. We're going to leave time for those rather than to alter the flow of the presentation as we work our way through. So Stephen, could you click the next slide, please? So here's just to give you a sense of the authors. So myself and Stephen, you know of us. So we were joined by 6 other gentlemen. Francis Barber, an eminent loss adjuster, very experienced in not only business interruption but also DSU claims. Adam Chapman, a broker, technical broker at Marsh Specialty, with much experience in large-scale projects, mostly in the oil and gas sector, including DSU. Andrew Coulton joined us from Hiscox. He's a marine cargo specialist with vast experience in the Lloyd's market, including DSU. Stephen Horn, of course, Kevin Lutz of Chubb European Group. Kevin is a lead underwriter in EAR, principally some CAR projects. His long experience has given him knowledge of DSU from European markets and also around the world. David Way of Lockton, based in Dubai, is also a specialist broker in business interruption issues and has a passion about DSU and some well-held views on how it operates from the client's perspective. And lastly, but not least, was Christopher Wilkes, a lawyer at DAC Beechcroft. So this book's been written by a consensus, a group of authors. So it's not one person's view expressed in one chapter. Each of us took various chapters, some several and some just a few, but each of us had the role of peer reviewing and challenging what was being drafted by the lead author for a particular chapter. I mean, ultimately, the lead author, or indeed myself, had the ultimate say, but broadly, we came to a very strong consensus amongst underwriters, brokers, and the others in what we put down in writing for this book. So 4 of the authors were involved in the previous book, Insurance of Revenue for Projects Under Construction, which was published in 2003. And this new publication absolutely supersedes that book. So if you have that book, you can put it to one side. And if you want to a deeper dive, a deeper understanding of DSU, then the new book is the one to refer to. As I've said earlier, it addresses not only marine risks, marine cargo and marine offshore CAR projects, but also non-marine, and the large focus is using CAR, EAR as the illustration. Many of the principles applying to let's call them onshore CAR, EAR project risks apply equally to marine risks. So there's not much to differentiate between marine and non-marine in the principles applying to DSU and how it operates. There are several new chapters in this new publication. The pre-existing chapters have been preserved with a much deeper dive, much clearer illustrations, much more experience drawn upon in the intervening nearly 20 years of additional experience we gained from the first book. And the readership is aimed at in no particular order, but without clients and their lenders, there is no DSU market. So let's put them first. This book is recommended reading for people who are interested in buying DSU insurance or providing capital or loans for projects. Brokers, of course, insurers, reinsurers, loss adjusters, risk engineers, marine surveyors, lawyers. They get involved sometimes when big numbers are involved and some unclear intentions on the parties. And whilst the book is written, as you might imagine, if it's commissioned by the Insurance Institute of London, has a English law and jurisdiction bias, and most of us are largely experienced from the London market. But where appropriate and where possible, we've introduced an international perspective in where some practices may differ. Let's say in the United States to America, a slightly different approach to wordings, for example, than in the international market. And the new book has a lot more about it regarding renewable energy. So we've as you would imagine, found the need to talk a lot more this time about renewable energy because of its growing importance on the world energy stage. So Steve, if you could change the slide. So I'm not going to spend too much time on this. This is a list of the contents of the book, the chapters. There's some 350 pages in the book, some 70 or 80 illustrations to make points clearer with graphics. But I just wanted to give you a sense of the breadth and depth of the subjects that come within this topic of DSU. There's sort of some 9 new chapters there. Sort of the whole section on chapter 12, increased cost of working, is a much deeper view of increased cost of working. Liquidated damages merits its own chapter. Chapter 14, loss sharing 50-50 clause, and several others appear for the first time in this book, as does the chapter on offshore CAR projects. May be of interest to EMEA members, as indeed the marine cargo section. That may not be something you encounter in your daily lives, but it's very important to understand how these other sections of cover operate, because they form the wider family of business interruption insurance concerning projects. As we work through our talk this morning with you, there's going to be sort of 8 of these chapters are going to be specifically referenced. I'll just sort of mention now to you. So chapter 3, business interruption explained. I said if you don't have a reasonable grasp of business interruption insurance, and you're handicapped in terms of understanding how DSU operates. We can talk about that a bit. Operations of cover, analysis of delay, chapter 7, very, very important chapter in the whole book. This is where Stephen will share his thoughts and points of view with us. The chapter on illustrative policy wordings is going to be talked about increased cost of working, qualified policy exclusions, extensions to the period of insurance, and Chapter 18, reinsurance and related topics. So, Stephen, if you could flick to the next slide. So, understanding the fundamentals of business interruption, or BI for short, is important. And I make the distinction between consequential loss insurance and property damage. So one thing that might be obvious to you is that one is primarily concerned about the cost of something, whereas the other is more interested in the time taken to do something. So material damage insurance is all about efficient costs. So, to try and repair or reinstate the damaged property the most cost-effective way, to put the insurer back into the same financial position he was before the loss occurred. On the other hand, business interruption is more about the time taken. So the quicker it can be done, the better off or the lesser the exposure will be to a business interruption claim. So those two things can be in tension, so cost versus time, and it's more difficult, I think, to visualize the impact on a profit and loss account, more difficult to visualize for the layman than physical damage. We see physical damage on our television screens, in films, in person, and it's easy to imagine a bridge collapse, a hotel damaged by an earthquake, and other pictorial evidence of physical damage, and we can sort of relate to the scale in our minds. Much more difficult to visualize the difference between 20 million and 200 million on a spreadsheet in an accountant's office, because just an extra naught makes a hell of a difference. But it's difficult to visualize unless you happen to be from an accountancy background. And from my knowledge, and I doubt whether the number of 400 or so people on this call would argue with me, that not many of the DSU practitioners, whether it be brokers or underwriters, come from an accountancy background. So given that's the case, we as a market, we may struggle to understand concepts of impact on the P&L account with more difficulty than we would visualizing physical loss or physical damage. So those with an experience in commercial risks and industrial risk insurances, which I guess many IMIA members are in that category, would have an advantage in having written or broked or adjusted business interruption claims on the back of a all risks policy. Operational risk policy would be an advantage. The issue arises partly because a standard CAR-EAR project policy excludes consequential loss. I mean, it's broadly true. There are some exceptions to that, but basically a standard EAR-CAR project policy is only concerned with material damage losses and not consequential loss. So if you want to cover the latter, you need a separate policy. One difference between DSU insurance and traditional business interruption insurance is the project, unless it's an extension of an existing works or property, it's unlikely that the business has been built or the project is being built will have previous trading results on which to base the total sum insured for DSU, or indeed as a measure to adjust claims. So this is a feature of business interruption insurance, is that you compare the period affected by the fire or the damage with the previous trading period, typically 12 months, and you use that as a reference point for your sum insured and your claim. For DSU, it's a bit more difficult because the business model or the trading assumptions supporting the project in the first place, when they first have the concept of the project and go to the banks to raise capital, raise cash to build the project, can be many years in advance of the actual date on which the loss might arise. So we have to keep challenging the assumptions around the business model when selecting a sum insured for DSU. And indeed, there's a fundamental difference to the approach to be taken with increased cost of working We're going to look in a second at the slide. There's two tenets to business interruption and DSU insurance. One is the actual loss itself, the loss of net profit, but also increased cost of working to mitigate that potential loss, and they're quite different in exposure to between BI and DSU, and I want to stress that, as the book does. I want to stress that later on. So Stephen, if you could just turn to the next slide. So here's the slide that appears more than once in the book because we want to keep repeating it. It's understanding BI and the DSU from a sum insured perspective. So this is again, unless you're an accountant, it may not be your first nature, but here we have the definition of the segments of the exposure which are covered by the policy. So we have a business that generates a turnover or revenue, and if that business is interrupted, either as an operational risk or as a construction risk or delivery risk in the case of Project Cargo, it will suffer a loss, and those losses are the subject of the DSU. And essentially, in this graph, we show that the parts of the business that are insured in pure terms, and we can refine that in a second, is the fixed costs. In other words, the costs of the business that continue even though the business is not operating, and the net profit generated by the business. What's not insured and need not be in the sum insured is the variable costs, the things that don't arise if the business is not operating. So there's the extent to which the costs are variable, they're not to be included in the sum insured and won't be included in the indemnity when it comes to paying a claim. So quite important slide this, and so we repeat it. I lost count. It might be 4 or 5 times in various segments of the book to really reinforce the point. Fixed costs. I'll just say a word about fixed costs because there's a particular fixed cost which often pops up for discussion in DSU, and that is the costs arising from debt service. So interest repayments on loans are dependent on the project being up and running in a given time, and if that time is not met, then those interest repayments still have to be made, and that's a classical fixed cost which should be in the sum insured for DSU, or indeed in some instances, we've touched on that, it can be the only item that's insured because the policyholders are willing to bear themselves the cost, the loss of the net profit for their own account. But Stephen, if you could go to the next slide. So I've posed a series of simple questions here. This is for introductory understanding of DSU. So a series of questions. I'll whiz through them pretty quickly. So what is DSU? Well, DSU is indemnity for delay in commercial startup of a business as a result of incidents or incidents in the plural covered under an associated marine cargo or CAR/EAR project policy. So as I said a moment ago, that CAR/EAR policy does not include consequential loss. So if you want to insure the delay in startup consequences, then you need to take out a DSU policy. And the parties that are likely to feel that way are the owners or prospective owners of a project which is coming under construction, and their lenders. So we say in the book, who buys DSU and why, and there's a great deal written in the book about the role of lenders for privately financed projects, and they often drive the need for DSU insurance. There'll be, whilst the building contract itself won't require insurance to be arranged, that confines itself to liability and contract works insurance, but the loan agreement certainly will, or is likely to, and it'll have all the usual non-vitiation issues addressed so that the banks, come what may, are protected. And so without the banks and privately financed projects, the demand for DSU will be much lower than it currently is. So who provides DSU? Well, it's pretty well the same underwriters that provide marine cargo and or EAR/CAR insurance. So there's a need to, as a commercial expedient, to have the material damage and the business interruption or DSU insured with the same parties, the same underwriters, and whether they provide it in the case of DSU as a separate policy. In other words, you have EAR CAR policy normally with two sections: Section 1 contract work, Section 2 third party liability for all the parties that involved in the project: owner, contractor, subcontractor, consulting engineers for their activities on site, etc. Whereas the DSU policy would only be in the name of the owner and or the lenders. The alternative and quite common approach is to have a single policy with an extra section. So the EAR CAR is Section 1, Section 2 liability, and Section 3 a DSU section only to the benefit of the owner or the or the lenders. It doesn't make much difference, but the potential for gaps to emerge between the two is greater when you have separate policies. So what comprises the sum insured for DSU? The little previous slide showing gross profit. In pure terms, it's gross profit that's being insured. In other words, due to a reduction or a loss of revenue, there is a loss of gross profit being net profit plus fixed expenses, including debt service, as the case may be. So I say who is covered. So that's the owners and lenders. They're the people who would suffer the loss and would be indemnified. Those not covered are contractors, subcontractors, and any other parties who make their profit from their price for doing the work. So their profit is derived not from the business itself that's going to be trading in the future, but from their own business model of tendering, and when they add up the cost of labor and materials, there's still a margin of profit for them. And they are rewarded in various other forms, and they have some adjustments to their profit potential through penalties and bonuses according to how they perform their duties. So what events are covered and what events are not covered? So this is essential point to be made, that there needs to be what we call a trigger event or events, so that interrupt the progress of the project and which delay the commercial startup. So this event, if it's a marine cargo, this would be a ship sinking on its way to the site from around the world, or any other form of transport being used, could have the delay in arrival on site could have a material impact on the progress of the project and would constitute a DSU marine cargo loss. We can imagine losses occurring, or incidents occurring, damage occurring on the project site at any time, beginning, middle, or towards the end of it, or at the very end of it in terms of testing and commissioning, which individually or collectively cause a delay in its commercial startup. That's what is being covered here under the DSU policy, and it needs to be clear in how that's expressed. Projects, as anybody will know who's had any sort of building works done in their home or whatever, is building projects rarely run to time anyway. And what DSU insurance is not providing cover for are general delays in the progress of construction. So if there are general delays not related to an incident of loss or damage covered by a EAR CAR policy, but general delays, bad weather, unforeseen conditions, strikes of the workforce, all sorts of other things that happen, particularly bad weather, these general delays are not covered by DSU, and we'll come on to how that's applied in practice. Stephen certainly will touch on this. It's a crucial point to his analysis of delay. And also the policy might exclude certain events. So general delays aren't covered anyway, but there's maybe some events which might be covered by an all risks physical loss or damage policy which are excluded. And that's also important to understand, that something excluded under a material damage policy and the extent to which it's excluded has a direct bearing on the potential claim under the DSU policy or section of policy. The thing to understand is that the delay in being insured is one moment in time. It's a single insured delay which can arise out of a number of trigger events. So cumulatively, the project can be delayed, by a few months at the beginning. They try and get back on track, and then another incident unrelated occurs, and that compounds the matter. And now the project's running a year late, and so on and so forth. And what matters is on the specified date when the business should have started up, work not for those incidents is when the DSU policy starts to pay. There is an attraction to having the material damage and the business interruption DSU with the same underwriters, and there is in any event a requirement to conform with what's called the material damage proviso. So if it's covered by the CAR EAR policy, then it's covered by the DSU policy in simple terms. If it's not covered by the material damage policy, with the exception of the deductible, which might apply, there might be a deductible which takes away the material damage claim, but nonetheless, it's so serious impact on the completion of the project that it does cause a delay. That would be an exception, but essentially, you need to have the triggering event covered by the material damage policy. And it's also worth knowing about when marine cargo policies start and finish, and when EAR-CAR project policies start and finish. And we spend some time in the book in various places discussing those two things. Essentially, marine cargo is from the supplier, the manufacturer's premises, by whatever means of cargo are used, air or sea mainly, until delivered to the site, project site, or some other place designated for delivery. And as soon as that delivery is completed, and I'll come on to that again later, then the marine cargo underwriters are no longer exposed. Of course, if they are exposed, if there is something that's happened during the cargo that delays their arrival on site, then they'll find out the impact of that several years later when the project is due for completion. So the EAR-CAR underwriters come on cover immediately at that same time. So there's a dovetail of as soon as the marine cargo policy terminates in terms of the period of insurance, the EAR-CAR policy commences. And there are occasions where the marine cargo ends on delivery to a designated storage area, and the EAR-CAR underwriters take over the transit risk from that place to the project site, and becomes an EAR DSU risk, not a marine cargo DSU risk. And the last thing to say about this, well, apart from one needs to avoid gaps in cover, make sure there's a clear understanding of when one policy ends and the other starts, as indeed there is at the other end of the thing when the EAR-CAR underwriters are looking to see their project handed over and taken into use, and broadly coincides with the commercial operations of the business. That this business is then insured under an annual all risks, fire and perils policy and annual business interruption. So at that moment, the DSU policy also expires. So lastly here, before Stephen takes over, is the topic of progress monitoring. So underwriters have an interest, as do banks, lenders, in knowing how the project's performing anyway. So what we call progress monitoring, often conducted by specialists engaged by the underwriters but paid for out of the premium. So it's certainly a cost to the owner. And the owner and his contractor will be aware of this monitoring process going on. But it's very important to know before a loss occurs or an incident occurs that could create a DSU claim, how the project's progressing anyway, because after an incident of damage or loss has arisen, it can be difficult to pick your way back through how things were anyway. And it's essential to know that because for reasons that Stephen will explain in a minute, the concept of insured loss, uninsured loss and concurrency. So Stephen, if I may take a breather there and ask you to take over this middle section of the presentation.
Absolutely. I think a well-earned breather there.
Thank you,
Stephen. Just one word on progress monitoring before we move on to analysis of today. It is obviously vitally important that we do have the right progress monitoring regimes set up. One of the the key sort of points of any successful progress monitoring regime from a DSU point of view is to make sure that we're tracking the right part of commercial operation and the right sort of critical path through to commercial operation. Often the progress reports that will be provided from a contractor or an owner's representative will be concerned more immediately with practical completion or final handover of a project, which will be the contractor's milestone for completion. Obviously, what we're really concerned about is commercial operation, and they can sometimes be driven by different aspects of a project. So they're aware of, and just to add to that point there. Guiding, these are a few principles really that help us as delay analysts understand exactly what it is we're trying to do and where we're trying to go. So what is DSU insurance? It indemnifies for the loss of anticipated future earnings of a future business. And I think it's important to keep that in mind with when we're trying to look at delay. This is very much something that is in the future. This is not a business that already exists or is already in operation. And this is a date that is at the date of a loss due to take place at some point in the future. The reason I think that's very important, we often find in a claims adjustment process, words like hypothetical being used as a very dirty term. We're not happy with the analysis or the adjustment as it's being undertaken because we're looking at this in a hypothetical way. But DSU, in its very nature, is a hypothetical product. We're trying to look at a situation that will not and has not ever occurred because a loss has now occurred. DSU aims to put the insured back to the same financial position that they would have been in had the incident not occurred. And again, this is a very important guiding principle for me and other delay analysts concerned with DSU, because it is very much in this retrospective past tense frame where we're trying to look at something that would have happened or might have happened but for something else. And that really is the but for sort of test of what it is that we're trying to look at. And then what is DSU delay? DSU is the additional period by which a project's commercial operation date is delayed as a consequence of covered causes. And I think the key word in this sentence is the additional period. We're trying to look at the project as a whole. We're not trying to isolate an extract of the project, a specific part of the project maybe that has suffered damage or some other delay. We need to look at the project in its entirety to really get an appreciation of what's going on. One aspect, and move on to the next slide, of what I'll try and do here is break the issue down into its simplest parts, as simple as we can make it. Project, very complex product, sorry. So we can't break it down too simply, but we have to try. And I think by keeping this in mind of exactly where we're trying to get to, it makes the whole process a little bit simpler. What we've tried to do, and I think the co-authors and Stephen would agree with me on this, with this book, is we've tried to remove as much ambiguity around DSU as possible. And we're trying to help all parties interested in DSU get to a successful resolution and conclusion of any claims that do arise from a project. Delay analysis is a funny one here. It's often referred to as a dark art. And I think one of the, obviously, other than taking huge offence to my profession being referred to as a dark art, we do want to try and remove some of that darkness from it, really. So at its simplest, DSU is very simple. It is the difference between two dates. It's the difference between the actual commercial operation date, what the insured actually achieved, but for any damage. And it's the difference between these two dates fundamentally that we're really trying to look at. I think it's important to remember or to be aware that DSU delay can only be forecast until the project is actually completed. At the time of a loss, and even at the point that repairs have concluded, it is merely an estimate as to what that delay will eventually turn out to be on the project. And that again is, if we talk about progress monitoring, that was talking about progress monitoring, but also to have some idea of progress monitoring post-loss, even to get an idea as where the critical path tracks, how the project is maybe able to mitigate successfully or otherwise some of the potential delays that it's facing. And again, because of that, we can only determine final delay once the project has completed. So just very graphically, this is something stolen straight from the book. Connection. Oh, so the connection's quite bad. Can you hear me okay, Stephen? Is that?
I can, yes. Yeah. You're breaking up a bit,
Okay.
but I can hear you basically, yes.
Okay.
Excuse me, someone has just, excuse me, sorry to interrupt.
Yeah.
Someone is saying they're battling to hear and see you. Can I have some hands up of other people who are battling with this? Okay, so perhaps just Stephen, if both of you guys can switch off your cameras. Oh, now I have a thumbs up. Okay, let's continue. Thank you.
Should I leave my camera on? Okay, I'll try and continue. It's fine now, right? Thanks. Ifti, nice to see you, Ifti, or hear from you anyway. Okay, so just graphically, we're showing the same here, the difference between these two dates. So to the left of this image, we've got the blue or the teal colour. This represents the construction period but for the incident. That will be comprised of both the period that was planned to be needed as at the date of loss to, or immediately prior to the date of loss to complete the works, but also any other delays unrelated to an incident that may have occurred. It's the culmination of these issues, these items that lead us up to the but for commercial operation date, the BFCOD. We then have what the additional impact is. As we move beyond the BFCOD, the delay that occurs beyond that date is therefore, by its definition, due to the incident. It takes us through to the ACOD, and it's that orange period between these two dates that is the DSU delay itself. So these two components, we've got the actual COD and the but for COD. The actual COD, as I mentioned, is a very simple date. We know what that is. We know when a project will actually complete. So we now need to spend a little bit more time. Okay, if the connection's still poor, let me I'll turn my camera off and see if that helps at all. So most of our focus, most of any adjustment team's focus and delay analysts' focus will be around the but for commercial operation date. This being the date upon which the insured business would have commenced had the delay not occurred. All policies, most policies, will include what we've referred to in the book as the anticipated commercial operation date. Quite often this might be referred to as the scheduled date for commencement of commercial operations, or the scheduled commercial operation date, or any similar sort of derivative from there. The word scheduled, I think, is quite an ambiguous term. It's not clear exactly what the schedule refers to. So we've tried to move away from that term in the book and move towards this anticipated commercial operation date. The reason this is important is it provides a date at the onset of the inception of the policy, not necessarily the onset of the project, but certainly very early on about what the expected completion date is likely to be of that project. This can be set many years before the actual commercial operation date takes place, and it goes without saying that in the intervening period there's likely to be many other issues that have occurred or could have occurred that may have affected the project's commercial operation date. I read a study a couple of weeks ago that talked around a study, I can't remember how large it was, but of thousands of projects around the world, and on average 80% of those projects experienced delay of some kind. So it gives us the idea that if we're looking at an anticipated commercial operation date set many years earlier, it may not be the most reliable date as we move through to try and test the point at which we should be measuring delay and startup from. So the question we need to ask is very much whether commercial operations would have commenced on the date stated within the policy had the incident not occurred. So we'd need to look at a whole spectrum of various other issues there. Was the project tracking on plan immediately prior to the date of loss? and everything that has occurred after the date of loss, whether or not this can be reasonably attributed back to the damage or the insured event, or whether some other cause is in there that may be forcing the project to be late as well. As I mentioned earlier, whether or not you could hear me or not, I guess from the connection, so I'll repeat here, but the but-for COD represents a hypothetical date. By its very nature, it has to be a hypothetical date because we are looking to establish a scenario that has never and will never exist. So there is a certain amount of subjectivity that's going to be needed to look at DSU. The importance whenever subjectivity is brought into play is to make sure that all parties are kept fully abreast of developments and interpretation and establishment of the facts throughout the entire process. A wait and see approach to DSU, I think, causes far more issues in my experience than a very transparent, collaborative approach. And the most successful claims that I've been involved with are very much those projects where all parties have pulled in the same direction from the very beginning, rather than waited to have a bit of a fight at the end, maybe. That is probably quite obvious. Just to move on, so still on the topic of what is the but-for commercial operation date. As many of you on this call, I'm sure, are aware, very few delay and startup claims have made it through to litigation, and there are very few not legal opinions, but legal precedents maybe that have come from DSU, especially when we're looking at the topic of delay analysis methodology. This is an extract from a case in 2017 in New South Wales, and I've highlighted a couple of paragraphs here from the judge's comments that refer very much to the methodology. So I won't read the whole thing, but the first, or the upper yellow box, we're saying that the period of delay, if any, begins on the date on which, if the damage had not occurred, completion would have taken place. And at the very bottom, the judge's conclusion is that the plaintiffs must demonstrate when practical completion would have been reached if damage had not occurred. The period of delay is then the period, if any, between this hypothetical date and the date of actual completion, in this case on the 21st of November 2008. This is quite an important extract, in my opinion, given the differences that you often see with DSU to a traditional construction contract and the way that delay needs to be looked at under a construction contract. Very few construction disputes will be settled through a but-for approach. They tend to be looked at far more from a prospective point of view, which is what is the expected delay, or what is the delay contemporaneously as it's occurring, rather than looking back on time, whereas DSU, being a matter of indemnity, very much calls for this retrospective approach, and that is supported by the Kate Byron case that we've looked at here, and we've referenced this in the textbook as well. So moving on, how does a delay analyst analyse? The first thing that we need to do is select an appropriate delay analysis methodology. This is similar to what we've just been talking there, the differences between a construction contract and an insurance policy and a matter of indemnity. Generally, a collapsed as-built method is the preferred approach, in my opinion. This is very much a case of taking the final as-built schedule from the project, removing any impacts instances of an insured event. That can be both direct and indirect. So by direct, I mean a physical postponement of progress, a physical constraint by which the project could not progress because of an insured event. And indirect impacts could be things like a sharing of resources, having to redistribute resources from one part of the project to another. So we may see some parts of the project not directly impacted by damage, let's say, but still being impacted indirectly by the effects of this insured event because they've lost some manpower, or they may have lost some plant and machinery to help with the repair efforts. So it's important to take both of these into consideration. There are times where a collapsed as-built may not be a practical approach to take. The impact of COVID-19 being a very nice example of this. Generally, when we remove the impacts of damage or an insured event from a project, what we're trying to identify is what the critical path of that project would have looked like had the event not occurred. Where we're just talking about a physical damage event, that's relatively simple, but it's simpler to do. The issue with COVID-19 is it created a very difficult issue for project managers in terms of prioritization, having to deal with reduced workforces and maybe having to deal with lower productivities depending on the construction constraints that they were facing, social distancing and so forth. So trying to look at what a project would have achieved but for a physical damage event where COVID-19 has been an intervening factor is very difficult, because fundamentally a project manager would have taken very different, I think it's fair to say, very different approaches with or without damage. They would have prioritized potentially a different part of the project, and this creates another layer of complexity and subjectivity into this process. So any delay analyst has to be a little bit more pragmatic. I think we're looking at delay, especially where using an as-built method may not be practical. The second step for any delay analyst is to verify the as-built schedule, verify the accuracy of it, the dates, the durations, the various relationships between activities, and also to try and verify the as-built critical path. It's not acceptable just to take a project as-built schedule and assume it is correct. Something that I do use quite often, and I should probably find a different example, but we all know anecdotally that Rome was not built in a day, but any project planner could show you Rome being built in a day on a schedule. So just because it's on paper doesn't mean that it is accurate. So we need to go through a verification process. That will involve looking at other contemporaneous project records. It will involve looking at a schedule quality check to make sure that the data we have in front of us is reliable and is accurate and is a good place to start the analysis from. This is a Primavera program. Quite often, from a contemporaneous information point of view, this is what a lot of our analysis is going to be focused on. For any underwriters or claims practitioners on the call, I think what is vitally important here is that we find a way to make sure that the raw native version of these programs are provided rather than just a PDF view. I think the simplest way of explaining it is effectively these schedules are a database of information. They contain hundreds of thousands, if not millions, of data points. Trying to look at a PDF would be like trying to understand a very complex Excel spreadsheet from PDFs. It very much is the same sort of issue, and I won't walk through all of these, but just to point out some of the information that is available from a PDF version. We can see all of the information. What we can't see are the inputs and the planner's touch behind the scenes. So it is possible to do some work from a PDF, but it does slow the process down. It does create a more protracted adjustment process, and ultimately will take away from the claims experience for all parties involved. So if we can get hold of the native versions, it really does speed up the process, and it does create a much better product through the end. So what does the analysis entail? The first step really of any analysis will be to verify the pre-incident position of a project. Is it on time? We'll then move through to identification of the post-incident critical path. So the first, once we've verified that a project is on time, pre-incident that is, we then need to start looking at what the impact of the incident, the insured event itself may be, and whether or not it is causing a critical path impact and therefore a delay to the commercial operation date of the project. We will then look to identify what we refer to as a return to pre-incident status. We think this is quite an important point to try and identify, because once we know that a project has got back to where it was, it may not have completed and commercial operations may not have commenced, but any delays that occur subsequent to this date are unlikely to be related to the insured event itself. So again, this is to try and bring a little bit more transparency to the process of the claims adjustment. We do obviously need to identify whether or not there are any concurrent delays that have occurred during the reinstatement that may act to supersede or erode some of the critical impact of damage. And of course, we need to look at the identification of any post-repair delays to understand the exact causation of the delay to the project itself. Once we've effectively carried out all of this work, we're then able to dissolve many of the insured impacts from a construction schedule. which creates the as-built schedule had damage not occurred, or specifically will then give us the date upon which the business would have commenced had the incident not occurred. So I've got a couple of very simple worked examples that try to bring this to life. These don't feature in the book, they're a little bit more dynamic, and unfortunately technology hasn't quite got there just yet. But just to give a very quick overview of what it is we're actually looking at. So we have here a very simple project with an original construction duration of 18 months, and is due to complete at the end of June, the beginning of July, on our example here. This project then suffers an incident, and quite often this is where the adjustment team will get involved. We know an incident has occurred. We don't know what the potential overrun is. We don't know what the planned completion date or the actual completion date is at this stage, and everybody is a little bit unsure as to what the exact exposure might be. When the project actually completes, we've just got this one narrative that we know there's a delay period of 12 months, and the project actually completed therefore a year late. So the original construction period of 18 months is now extended out to 30 months. But we don't know within this period, are all of these 12 months, is the entire delay due to an insured event itself, or is it due to other factors? So part of the delay analyst's role is to try and bring a bit of clarity to exactly how the project is broken down. So typically, or as an example, we may see something that goes together a little bit along these lines. So we can see a 12-month period of pre-incident works. We know the project was 12 months into its construction period as at the date of loss. As I mentioned before, the first step we need to look at is pre-incident delay. So when we look at the schedules and we look at where the project was immediately prior to a loss occurring, we can see that the project was already tracking 4 months behind program. So there's a 4-month pre-incident delay there. We find that the incident-related repairs actually took a period of 5 months. And once these repairs are completed, the project is then back at its pre-incident position. It's returned to pre-incident position. So at that point, we've got the remaining construction period of 6 months. So an original construction duration of 18 months, of which the project had progressed 12 months of prior to the loss occurring. There is at least 6 months remaining, so we can put that in. But these 6 months work actually end up taking 9 months. So there's a further overrun of 3 months. And this is then how we're able to break down the project actual duration into some key components. So the next stage is then to try and understand what that would look like from a DSU point of view. So as we build it up, again, we would always have had, but for the insured event, the pre-incident 12-month period, and also the 4 months worth of pre-incident delay. We would no longer have the repairs. They would not be required if there were no incidents. So we'd be able to progress straight through to what would have been the remaining construction works, the planned duration of 6 months. And we know that these 6 months would always have taken 9 because those final delays occurred after the project had returned to its pre-incident status. And therefore, these delays are likely not related to the incident itself. So that would give us a but-for scheduled completion date at the end of January versus an actual date at the end of June, or a but-for construction period of 25 months versus the actual period of 30. And therefore, we have a 5-month delta. A 5-month delta, which is therefore the DSU delay, the difference between the but-for date and the actual completion date. Just as a follow-on from there, one of the other key issues that we often come across on DSU delay is float, and specifically the ownership of float. When I say float, what I'm referring to is any contingency or buffer that a project or a specific set of activities within a project may have before a delay to those activities would therefore impact the completion date of the project. That really is contingency within the project schedule itself. So if we're looking at the top third, or the top few bars on this graphic on the screen, activity A is due to complete around about day 130 of this project, and then it has an 80-day float period before it would start to impact the project commissioning, which is directly driving the scheduled commercial operation date. So in this example, the critical path of the project would be through activity B, which is then driving project commissioning, which is then driving the scheduled commercial operation date. If we look at the post incident, there is then an insured event, which is highlighted by my red star on the screen here. This insured event creates an 80-day repair period, which then causes a delay and pushes along the completion of activity A. But in this example, we can see that whilst activity A itself is completing 80 days late, it has not caused any impact to the start of project commissioning or the scheduled commercial operation date. So in this example, we have an 80-day insured event, or repairs lasting 80 days from an insured event, that caused no delay to the final commercial operation date of the project. So therefore, there would be no DSU entitlement in this case, because this issue has only eroded float that was available to the project rather than causing a critical delay. Where this becomes a little bit more interesting is then if we see the yellow bar sort of towards the middle of the screen here, we then have an uninsured delay event that follows on from activity A and causes a delay to the start of project commissioning. Typically, what we would see in a construction contract is that the 80-day delay itself has caused, or the 80-day repair period has caused no delay to the project, and that the delay to the project has all been caused by this uninsured delay event. For DSU, what we're trying to look at is this but-for position. Had the 80-day delay not occurred, would the project have completed quicker? In this scenario, we can see that activity A is driving the critical path and no longer activity B. So, but for these 80 days, we would have to conclude that yes, the project would have completed 20 days earlier, which is the delay that was experienced following the uninsured delay event. So even though the insured event, which has caused an 80-day repair at the time, caused no critical delay to the project, a subsequent event has then caused a delay to the project that would have meant, but for the insured event, the project would have completed earlier. So I guess what I'm trying to show from this slide here is whether or not an incident causes a critical delay contemporaneously at the point that it occurs is not necessarily going to be equal to the final DSU entitlement. And we can have, that can work both ways. So it can be that an event may not be critical contemporaneously, but may end up being critical retrospectively. And equally, an event may be critical contemporaneously, but in a retrospective path of things is no longer on the project as built critical path, and so it has not actually caused an impact in the end. So it's very important that we do have a good monitoring regime throughout the post-loss event to understand exactly whether or not a critical delay ends up being critical or not. I've got just a very simple sort of dynamic scenario to maybe bring this point through a little bit more. So we've got a very simple construction project, and those activities with the red line around them denote the critical path of this project. So the critical path runs through activities 1, 2, 4, 5, and 6. Activity 3 has some float available to it, and in this scenario, it's got a 4-month float period. So we can see the little green line denoting what the float is from months 10, 11, 12, and 13. So if activity 3, similar to the previous example, was to suffer a 4-month delay due to an incident, it would also become critical, but has not caused any delay to the commercial operation date of this project. However, if what I've referred to here as an in any event delay or an uninsured delay was then subsequently to occur, we would then see a critical delay to the project and the critical path going through activities 1 and then 3 all the way through to commercial operation. Back to our DSU principles, we need to understand what this project would have looked like had the red bar not occurred. So by removing that from the project, we can see that the completion date would have become earlier. And again, there would then be a DSU period of 4 months. So same scenario, at the time the insured event has not caused a delay, but in retrospect, the project would have completed earlier but for, and therefore there is a DSU entitlement. Similarly, if we had activity 3 with the same incident, but instead the in any event delay is now impacting activity 6 rather than activity 3, we'll see that but for the effect of activity 3, the critical path would stay the same, and there would be in this scenario 0 DSU. And this is the difference between which network path, which part of the project is driving the as-built critical path and not just the contemporaneous critical path itself. And similarly, if we had in any event delays to both activities, still we would see no impact to the actual completion date at the end, and there would be 0 DSU in these scenarios as well. So I appreciate that is a bit of a whistle-stop tour of DSU delay analysis methodology. And I guess the takeaway is it is very complex. It can change a lot. And I really do think it's transparency and collaboration that is going to be key to trying to unlock a successful claims process here. And I think now I hand back over to Mr. Coward.
Thank you, Stephen. That's very, very interesting, and illustrations make it much clearer to understand for us all. So thank you. I'm conscious of the time. It's coming up to 12:15 in UK. I think we've got another 15 minutes or so. I don't want to eat into the question and answer session, but I'm going to whiz through these points quite quickly, if I may. So one of the big things we found in our research whilst writing the book was the lack of clarity or ambiguity written into a number of policy wordings. There's very few projects have the same wording as the previous contract or project in onshore construction and erection. On the other hand, well car and wind car, which are the market wordings applied to offshore CAR projects for wind farms and pipelines and so on and so forth, tend to be market-wide wordings, and there's less concern about those wordings. Equally, the Joint Cargo Committee's JC20 wording is now market standard wording for cargo and DSU cargo. But on the EAR-CAR front, we were concerned and remain concerned that there was a number of unclear words used, contradictory terms used, inconsistency within one policy. 1 minute it's referencing an excess and the next minute it's a deductible. They're quite different things. Policies without specifying the date the commercial business was due to start up. Stephen's already mentioned is trying to move away from the term scheduled, because the term scheduled doesn't necessarily mean the policy schedule, but other schedules which appear as part of the building and lending scheme. Quite a lot of confusion over how to handle phased handovers or progressive startups of businesses. Even a commercial building can have various floors being opened for letting before the whole building's finished, and not to mention combined cycle power plants where you've got distinct phases of operation, simple cycle in a commercial mode and passing back to contractors for commissioning of the combined cycle mode, presents unique issues for the DSU date on which the business is anticipated to start up. So we need to be conscious of different revenue streams within a single project. The definition of the indemnity period is a challenge, unclear when it starts. This is as distinct from the policy period. So you've got a period of insurance and the period of maximum indemnity following a delay. So they're different things and don't run concurrently in a DSU CAR policy. A number of these concerns about wordings are that a number of the terms and words used in the DSU have their origins in the drafting of material damage policies. And I'll come on to a specific illustration of that in a moment. So the drafters of DSU policies need to be clear that the intention of the parties, and the buyer is getting the cover he's expecting and is paying for, and the underwriters providing the cover that they intend, are more clearly expressed in the words used. And I think there's a lot said in the book about this. We don't give a model wording, but we have a whole chapter on an illustrative wording, drawing out some clauses that ought to be included and some that are problematic. So we give a framework for drafting an optimal EAR-CAR DSU wording without citing an exact example, whereas in the marine field you do have examples of well car and wind car and the JC20. So it's like a health warning baked into the book about words, because if those words are unclear and the parties have misconceptions from the beginning, in 4, 5, 6, 7 years time when a claim occurs, then it presents difficulty and is a feeding ground for the lawyers who rub their hands with glee when ambiguous wordings are put before them in what might otherwise be a straightforward claim. The increased cost of working is a topic which is addressed in depth in the book, and it's for this reason that the increased cost of working is spending $1 to save $2 is essentially what it is. So if you have a business interruption claim on an operating factory or plant, it's clear that when damage occurs, and it has pretty well immediate impact on the business, and part of the business or all the business is shut down. So you have a period of insurance, and coinciding with it a period of indemnity, which may well expire outside the period of insurance, when a new period of insurance would be arranged. But essentially, it's very clear to see that by spending $1 in an operating risk to save $2 is going to be worthwhile or not. And that makes the decision to trigger the ICOW section of the operative clause of a BI policy quite straightforward. Both parties, the insured and the insurer, can see the benefit of spending $1 to save $2. It's not as straightforward at all in the case of DSU, and it brings a bigger risk to the parties, in that, as Stephen alluded to here, you could decide to mitigate the impact of a event which is interrupting the construction progress by accelerating work or other works, reorganizing it at an additional expense, in expectation, in the hope that in the future that will mitigate or avoid entirely the delay in startup. But as Stephen said, it's looking back on what actually happened that matters. And what I captioned here is quite likely that insurers might face unproductive additional expenditure. In good faith, the insured is spending money to try and bring his project back on track, only to find that either other uninsured delays, general delays, arise, which trump, if you like, the impact of the in the insured delay, as Stephen's graphics just showed, or indeed, despite spending $1 to save $2, another insured event subsequently occurs, a second event, which anyway makes the project delayed. So the spending, the indemnification of this additional expenditure doesn't bring itself a guarantee that the loss will be avoided or entirely mitigated. That's a risk that underwriters have to take. So you can't claim it back if you pay out an ICOW claim of $10 million. And it turns out to be unproductive. That's money spent and it's gone. What it does do is it impacts on the sum insured for the remaining claims that might still arise. So if you have a 24-month indemnity period and you've spent and have a 24-month indemnity period and a sum insured of 20 million, and you spent 5 million in ICOW, and it turns out to be unproductive, you still got a 24-month indemnity period to play with at the end of the insurance period, the beginning of the indemnity period, but you've only got 15 million sum insured left. So you'll exhaust the period of indemnity quicker than you would otherwise have done, which is fair because the principle of spending $1 to save $2 wouldn't work otherwise. The other one that which pops up for special comment is the question of qualified policy exclusions. So it's clear that something that's excluded that is not indemnified under the EAR policy or the DSU policy, that's clear. However, there are some qualified policy exclusions where, yes, there is an exclusion, but some cover is brought back by way of indemnity for part of the claim if it arises. So the best example of this is the defects exclusion or the corrosion exclusion, where we all understand that defects per se, the existence of a defect in project works, is not insured, but if it causes damage to undefective or non-defective property, that there may be cover, and that's the difference between leg 1, leg 2, and leg 3, or the DE clauses, exclusion clauses 1 to 5. So there's an issue to be analysed here as to the impact of of a leg 2 versus a leg 3 exclusion in terms of DSU. So the delays might arise due to the rectification of a defect. So that itself takes time, as distinct from delays due to the repair work. And as those of us that know that the leg 2 excludes defects and excludes the costs that and I use the word costs with a stress to the word cost, excludes the costs that the insured would have borne had the defect been apparent immediately before the insured damage arose. So there's two things running concurrently here, and the principle of concurrent delay under English law, at least, is that if there is an excluded delay and an insured delay running concurrently, that the uninsured delay takes precedence. So you would say if there was a defects claim indemnified under leg 2 and the rectification period caused a delay of 6 months and the repair period resulted in a period of 6 months, there will be no claim paid for the consequent delay. However, if there was a delay due to the rectification work of 6 months for the elimination of the defect, that corresponds with the work that the insured would have had to have done had he known the defect was present immediately before damage. But the repair work takes 9 months. So you've got 6 months of concurrent delay and 3 months of purely repair delay, and my view is that 3 months is covered by the DSU policy in principle, subject to its other terms and conditions, deductible and so on, not the 9 months. However, I'm in the interest of transparency, and this is one area in the book where the authors weren't able to come to a consensus view, is that there's another view expressed in the book that says that because of the wording of the leg 2, leg 3 clauses, in fact, once there's damage, then the whole of the delay is covered by the DSU policy. And there's some arguments why that might be rehearsed in the book, but it centers around the word cost. So I happen to know, because I was there at the time, that when these leg 2 exclusions were drafted, and they've stood the test of time quite well since 1996 and 2006, that there was no thought in the drafters' minds about DSU. There was purely exclusions to address material damage claims, and the use of the word costs has to be understood in that context. But there's a legitimate argument to say that because it's talking about costs, and there's no costs as such in the DSU claim, that the whole of the claim for the delay, the defect rectification and the repair work are fully covered by the policy. And those two views are aired in the chapter 15, I think it is, in the book. So I think anybody with a keen interest in defects should be conscious of that. If we can flip to the next slide, Stephen, I'm just going to have 4 more points to make before we hand over to Q&A. So I talked about earlier, and I'll therefore leave it there mostly. There is a very important interface between the marine cargo and the EAR-CAR policy. When is delivery to site actually concluded? When can the marine underwriters let go a sigh of relief? It's can be very complicated in offshore CAR, where there can be a transit risk to the site where the wind farm is being erected. Is the big blade is on the hook from the transport risk, and then when does the contractor take over, or is it one seamless cover? These interesting questions. The point to make here about marine, I talked earlier about non-vitiation and the lenders, so big drivers of DSU insurance. One thing that popped up from our work in the book was that it's worth noting that the marine surveyor's warranty clause, which appears is a key factor of marine insurance, that there's a sort of independent surveyor verifies the vessel seaworthiness and the way it's loaded and its suitability and so on for its freight. It is a condition precedent to the cover. So even the non-vitiation clause which we're familiar with in standard CAR EAR project policies where project financing is involved, would not be would be trumped by a breach of the marine surveyor's warranty. So bear that in mind. The banks have had to accept that if there's a breach of the marine surveyor's warranty, unsafe cargo is dispatched or unsuitable, then all the cover is avoided, not just for the owner's interest. The whole section on the book about 50-50 loss sharing. So this is where damage is discovered after delivery has been taken, and they start to unpack the goods on site and find there's damage. There's a clause that exists in the market, 50-50 loss sharing clause. It's drafted with material damage in mind, and it says that until we can establish exactly when damage occurred, the EAR and the marine cargo policy will pay 50% each of the loss. Now, how does that translate to a DSU policy where both DSU and so marine cargo and EAR CAR has a DSU section? How does that 50-50 loss sharing clause apply? And there's a lot said about that. And in the first instance, one needs to ensure that if you have a 50-50 loss sharing clause on your policy, the EAR policy, then there is one on the marine cargo policy to counterbalance it. The extensions to the period of insurance, this is a chestnut which many of us have wrestled with. This is, as Stephen has said in his illustrations here, if there's a delay in the project generally, then it's a fairly straightforward matter of moving out to a new date, the anticipated date when the project would be completed. So you're moving out the date. There's an extension to the period of insurance. There's probably an additional premium to be paid, but you're pushing back in time the date on which the DSU claim could be made. Now, that's a choice that can be made. Now, if the date is going to be missed because of an insured delay or a potential DSU delay, then a different situation arises. And again, in the book, we talk about the need to reinstate the period of indemnity for losses which arise outside the original period of insurance, plus any extensions. In other words, DSU is a single point in time, notwithstanding possibility of phased handover, where the business either does commence or doesn't. And once that occurs, the business is either trading or you're in a DSU claims situation. So if you want, and that delay can be prolongated because repairs take longer or interfered with other factors, all of which will be covered by the policy up to the end of the indemnity period. However, if an unrelated new event occurs during this period of indemnity, but outside the original project policy period, then the insured needs to negotiate, and the underwriters need to provide what we call in the book a reinstatement of a new indemnity period for such future events, with a new deductible, a new indemnity period, new sum insured, and all that goes with it. That's just scraping the surface of it, and there may well be questions on this later. Lastly, almost penultimately, suppliers and customers extensions. This is a common feature of any business interruption operational risk. In DSU, it has two aspects to it. One is delays on the supplier side. So if a supplier suffers an event, fire at his factory, delays supply to the project, that could be covered under an extension with its own sublimit, or to the business. So the insured business might be ready to start up, as Stephen's illustration showed. We finished on time, but the but-for date is met, but because a supplier or a customer who's contracted to supply or take away product has itself suffered an event, whilst not covered by the material damage EAR-CAR policy, could be covered by a DSU under this sort of contingent DSU cover, which is important to know about and to monitor and to recognize the potential accumulation of more than one project being affected by the same incident at a supplier's or customer's own premises. And this is it's a small point, but worth making, and often, in my view, glossed over too readily in the drafting of policies and the calculation of the premium. And lastly, before we hand over to questions, if there's time, is the question of capacity and reinsurance. So whilst EAR-CAR projects, large scale particularly, those spread over large areas of land, lend themselves to an assessment of probable maximum loss, or EML, estimated maximum loss, which is a calculation less than the full sum insured or estimated contract value of the project. In the case of DSU, it's unwise, in my view, to apply the same principles to DSU. The insured selects the maximum period of indemnity. It may be 12 months, it may be 48 months, it may be any period that he thinks that the business could be interrupted by. And I think they know their business better than underwriters might, and I think it's wise to start with a assumption that the maximum indemnity period could, in worst case scenario, result in a total loss. So you have an accumulation of risk between the EML for the physical damage risk and the total sum insured for the DSU risk added together to present quite large numbers, and quite often rely on reinsurance to assemble that capacity. And one just needs to be aware of certain types of reinsurance, particularly excess of loss reinsurance, based on losses occurring during a 12-month period, for example, where one has to recognize the date of the interruption that might lead to a delay in startup 2 or 3 years down the line, and the actual date of the delay, according to the illustrations that Stephen showed us. So they could span different treaty years, and it's important that both the cedants and the reinsurers agree how to treat such differences in time. And if on a risk attaching basis of reinsurance, or indeed quota share reinsurance, if there is a reinstatement, effectively a new policy for the issue arranged after the original period of indemnity has commenced, then which year of account does that fall into? Does it go back to the original underwriting year when the project first commenced, or is it the current year when that reinstatement took place? And these are concepts to bear in mind. And lastly, underwriters on this call need to be conscious of how premiums are earned over time. It's a interesting topic on the material damage front, where depending on the type of risk it is and where it is and so on, that there will be a premium earning curve starting with 0 on day 1 and ending up 100% on the last day of the policy. But I think there's potential for a different curve being applied in the case of the DSU premium. So whilst halfway through a project or 3/4 of the way through a project, underwriters might be seeing quite a large part of their premium having been earned for accounting purposes, it might be too risky to assume the same amount of earned premium in the DSU curve, because a claim incident late on in the project can have catastrophic effect. No time to make up for lost ground, no float to rely on, no chance of an intervening uninsured event occurring, and you're into big claims territory for which the premium needs to be earned to recognize that curve. Okay, there's lots more we could talk about. I think we've overrun our time somewhat. I'm going to ask and thank the audience for staying with us. I can see majority are still on the call. I'm not sure whether we have I'm going to ask Stephanie to guide me on the matter of questions and how we are going to deal with them.
Thanks a lot. I don't know, Stephen Horn, have you been reading the questions, or shall I just read them out?
If you can read some out, Stephanie, that'd be great.
Okay, so one of the first ones that came was from Helen, and you may have already answered it through your explanation. Anyway, I begin. We see lenders becoming exigent or unflexible when it comes to inserting their clauses into policies. How can we as an industry work to, 1, educate lenders on what is possible and what is not, and 2, are the LMA or others working on some standardization?
I'll answer that, Stephen, if I may. So I'm not aware of the LMA. We can find out for sure, but I'm not aware of the LMA doing any work to try and standardize the influence of lenders over this. Now, without lenders' money, there's no projects, or fewer projects, and we need to, within reason, meet their meet their demands. The book does have quite a lot in it for lenders. The chapter 2, I think it is, who buys DSU and why, does set out with a lender reader in mind what's reasonable and what's possible and what's not. And I just cited the case. I think non-vitiation lenders clauses are fine if you recognize the extra risk you're bearing by providing it and charge an appropriate premium. There's a greater risk involved in providing non-vitiation than without it, for obvious reasons. For DSU, I think the same applies. So if you're going to, it's not a unique DSU issue, it is a project insurance issue. And I'm glad I mentioned that the lenders, whoever they are, have had to accept that in the marine cargo world, there's no way round, even from their own interest, to have insurance where there's a breach of the marine surveyor's warranty. But I will inquire for this group to what extent the market in London is trying to standardise or respond to, let's say, ever demanding terms from lenders. The market, of course, does yield to these things in certain cycles. I mean, I think lenders can have their way more readily in a soft market, or where not enough attention is paid to the implications of lenders' agreements. But in a harder market, where fewer leaders are available to provide leadership on these sort of projects, it might be easier to push back on some of the more or the less reasonable demands of the bank. But that's the best I can offer at this stage. But I will check whether the LMA is trying to do something on this.
Okay, thanks. Another one from Isabel. Debt service. We understand interest payment are part of debt service, but do you consider capital repayment as a debt service indemnifiable under DSU?
It's a great question. So first of all, debt service only is insurable, and there's many policies just providing debt service because that's all that the banks want covered. And the sum insured would be much lower than the gross profit sum insured, and therefore the premium generated will be lower. However, the rate of premium would be higher. So I didn't talk about rating and how to price DSU, and that was intentional. But I can tell you that if you're only insuring debt service with a reduced sum insured, then the rate of premium will be much higher than if you were applying it to a full profit sum insured. The question of capital, so this is discussed in the book. Remember that the policy is one of indemnity. So to put the insured in the same financial position that he would have been in had the loss not occurred. So it's easy to see that the interest repayments fall well within that definition. It's not as easy to see that capital repayments would. However, there are instances where cover has been explicitly given with a sum insured, not confused with fixed expenses, but a separate item that the insured is asking for capital repayments for a certain period, maybe not the whole of the indemnity period, but as a separate item in the DSU section, and that has been covered. The rate of premium for it would be different from the interest rate, I think. But so there are instances where that has been given, and we do acknowledge that in the book.
Okay, thank you. Another one, is it practical to cover DSU on a separate policy when the corresponding MD policy has been issued by another insurer or pool of insurers?
Yeah, no, it's not. It's unlikely that an underwriter would be willing to provide DSU in isolation to involvement in the material damage insurance because of the need to balance the cost of repair versus the time taken to execute a repair, as I mentioned earlier. So there's very limited market that I know of that would be willing to provide only DSU. It has arisen where in excess of loss, where someone has had to take out a bigger sum insured midterm, and the current providers couldn't accommodate it, and there was like an excess of loss for excess of loss insurance for the upper end of the DSU exposure, but because the control of the claim, material damage and DSU really needs to be in the same hands, I think it's unlikely that the separate standalone DSU market could be developed.
Okay, and then Maggie says, typically, would contractor include any float along the critical path?
Okay, sounds like that's one for me. I've seen Mohammed's asked quite a similar question as well, and I'm not sure what he's referring to, but wouldn't that incentivise a general contractor to give insurers a critical path without float? So to answer Maggie's question, yes, a contractor would include float along the critical path. And to answer Mohammed, and I'll expand on these in a second, but no, I don't think anything else would incentivise a general contractor not to include float. To provide a little bit of background of that, before I worked for CCI, my job was a planner for a general contractor in the UK. As any construction contract would be set up, most contractors will be subject to quite heavy liquidated damages should they not complete on time. And most contractors would err on the side of caution when mapping out their critical path. As a very simple example, when I was putting a program together or a schedule together, if an activity was expected to take 3 days, I would probably show it having a 5-day duration within the program itself. So you've got a little bit of flexibility, or effectively float, although it wouldn't show in the schedule as float. So that's the way that a contractor will include float along the critical path.
Yeah, Stephen, I'd just like to add that from an underwriting
important thing there to make sure. Yeah.
From an underwriting perspective, underwriters would pay attention to the degree of float in the project when underwriting the DSU risk at the outset. So a project with loads of float in it is attractive, and one with less or no float is unattractive, and it will be reflected in the premium charged and the terms and conditions offered by the underwriter. So whether that float is around at the time you need it is another matter, but if the project has legitimate float built into it and it's visible, then the underwriters would give credit for that in assessing their exposure.
Yeah, but I think also from a contractor's point of view, not having an interest in the DSU, their main concern will be the construction contract itself and their terms and conditions in line with the construction contract. I don't think their behaviours would be influenced by what insurers are under.
Stephen, you mentioned the term liquidated damages.
There will be float on the critical path.
Okay. Stephen, you mentioned liquidated damages there, and again, there's a chapter on liquidated damages. Just to say that we've people often ask, to what extent is liquidated damages covered? And to that we say they're not covered under the DSU policy, but and they shouldn't hold up the settlement of a DSU claim. We've heard instances where underwriters of a DSU have delayed or wrangled over settling the claim because they expect there to be some contractor contribution from liquidated damages or penalties, and that's not good practice according to us and the book. The DSU is a primary insurance to indemnify the owner in the way we've just discussed, and if there are subsequent, and they could take years to iron out, if there are recoveries from the contractor by way of liquidated damages to the benefit of the owner, then that becomes a recoverable amount to the underwriters. It'd be a subrogated right, rather than a reason to say, hang on, we're not going to pay the DSU claim until we know the outcome of the liquidated damages negotiation. Stephanie, are there more questions?
Yes, there's plenty. Sorry, Jamie says, how should or not period extensions to CAR/EAR policy affect the adjustment of a DSU claim from an insured event that occurred prior to the extension?
I think I have to have that question written down so I can get my head around it. So the extension to the EAR/CAR policy is a matter of time, and that doesn't a factor here. If the DSU policy is triggered, in other words, the but for date of commencement of operations is missed, and the underwriters start indemnifying the policyholder, there's no further adjustment to the premium for the DSU, but the contract value may increase because of the extra time taken to finish the project, and that would be a matter for the EAR-CAR policy adjustment premium, not the DSU policy. I hope that answers the question. I'm not sure it does, though. I would need to think a bit more about that, or understand the question better than I think I have.
Yeah, okay, I can send you a copy later.
Please.
Then we have Abigail. Okay. Have you got any actual successful example DSU claims that you could discuss?
Yes, the book has a chapter at the end with half a dozen or more that anonymized, but we have rehearsed, well, not rehearsed, but we set out in sufficient detail, we think, to make the point about how DSU claims have been settled, how they've been partially settled. In the book, there's a chapter on actual claims without naming them, for which I think was a range of samples on renewable energy, conventional property risks projects, where by illustrating actual claims, we hope to reinforce what's covered and what's not covered. So again, the book has them. I don't have it in front of me, but yes, we could discuss actual claims. There've been a number. I mean, a lot of high-profile disputes have arisen on DSU, but they're not in the court. They're not in the public domain because they're mostly dealt with under arbitration, which is, as you may know, it's got confidential between the parties. So, but there are plenty of, as should be the case, there are plenty of bona fide DSU claims which are being paid without any fuss, and to the satisfaction of both the insured and the insurers, and that's how it should be.
Yeah, and I think to add from that, I'd agree. We do have a number of examples of successfully resolved claims without the onset of any disputes, but I think the common denominator in all of them is that the parties approach the claims with a pragmatic view and do work collaboratively. And I think, again, COVID-19 is maybe one of the more proximal issues that we've dealt with as a firm recently. And in 2020, there were a number of DSU claims that involved COVID that were dealt with successfully and resolved successfully. So I think that's a good example of companies and firms and parties working very collaboratively to reach a pragmatic and expedient resolution.
One of the motives for writing this book was to try and remove the wrinkles and the ambiguities and the conflicts that can arise between parties, entering into a contract in good faith in the beginning, and then whether it's through insured or uninsured issues or disputes, things break down. But if the guidance offered in this book were to be followed, I think there'll be fewer and fewer grounds for dispute between a legitimate claimant and the underwriter whose business is to pay claims. I mean, somehow or other, I get a feeling, in ignorance, DSU has a bad reputation for being a type of insurance where lawyers always get involved, and I don't think that's the case. I don't think that's fair to say, but I can see how it happens. And by looking at some of the policies that we reviewed in the onshore side, it's no surprise that someone with an intention could drive a cart and horses through some of these wordings, and it's regrettable. And that's why we say in the book a lot more attention needs to be paid to the drafting of wordings. The whole wording and this clarity of the schedule and the recording of dates, and recognizing that some words were drafted with a material damage concept in mind, not a pecuniary loss concept in mind, or sorry, a business interruption concept in mind, and the two often need different words. to have the same outcome.
Okay, thanks. Another one. Any thoughts on setting the correct insurance period and what happens when non-accidental events require the policy to be extended? Will the aggregated time deductible be reset?
No, that's a good question. The indemnity period is the choice of the insured. So the owner, the person buying the policy, must decide how much, to what extent he wants to buy cover, by what amount, for what amount, and for what period. It can't be the insurer who provides that decision. Obviously, the market can respond with capacity, and if someone wanted a 72-month indemnity period for a project taking 2 years to build, it'd probably get turned away. But within reason, the indemnity period, the maximum period of indemnity, rather, to give it its proper term, is selected by the insured, guided by his advisors, whether it be the banks or his insurance broker. So having set the maximum period of indemnity and the sum insured to correspond with it, the underwriter would provide a rate of premium applied to the sum insured for that period. So obviously there's a higher premium to be paid for a longer period of indemnity, but not proportionate. 4-year maximum period of indemnity is not 4 times the premium for an annual period of indemnity, maximum period of indemnity. But the question of deductible, the deductible is expressed in time, so 30 days, 60 days, 90 days, commencing from the date the business is interrupted. So it runs concurrently, essentially, in simple terms. It can be slightly more complicated, but simply runs from the beginning of the indemnity period. That doesn't need to be reset. That is there to deal with the first claim, the only claim that's going to arise under the policy when that date is missed. If the policy is extended, that date has either been moved forward in time or stayed where it was, and the deductible period is applied from that date. It doesn't need to be reset, and the application of deductible is a calculation to convert it into financial numbers, so dollars or sterling or whatever currency, and is applied to the financial settlement of the claim when it's arrived at. As Stephen said, most likely when the business is up and running, because until that moment you don't know the full extent of the DSU claim in terms of dollars, and the 30-day, 90-day deductible will be converted into a monetary amount and applied either in one of 2 ways. One is literally the first 60 days of the loss, or the average value of all the days divided by 60. This is more commonly the case.
Here we go. You may have already answered this. Next one. Related to the DSU indemnification, it was referred to debt service indemnification. Many loan agreements today include straight amortization. Other times, amortization is flexible. Can you please elaborate on its insurability under DSU?
I'll need to turn to my accountants for guidance on that. Yeah, I think not sure you can start amortizing an asset which hasn't been taken into possession. I'm not sure about the answer to that question.
Okay, then I think looks like a conversation going between a couple of the people. They might be answering that. Okay, I'll try this one. Do you guys understand that the serial claims clause should apply for DSU coverage?
Yes, I do. Yeah, that's not. We don't address that in the book, and that's regrettable. So, a serious loss clause says that if you've got similar machines, I think it's more a machinery insurance thing. So you've got the first loss of a type of a cause is paid 100%, the second one is paid 75%, and so on, down to nothing after 5 machines are being affected by the same cause. So that should translate into proportionate response from the DSU, where the 5th machine has no indemnity for the material damage and has no indemnity for delays it might cause, and the proportions specified in the series loss clause would apply. It's similarly, we didn't, this is something that occurred to me after publication, that open trench warranties, which some will be familiar, where those ensuring pipeline laying or road building or breakwater construction will have a limit as to how many kilometers that the policy will respond to, like an open trench warranty of 5 kilometers. And if the insured has a flood loss of 20 kilometers, he's only going to get 25% of his claim paid. It's a bit like the example of the leg 2 and defects. There will be an opinion out there that says that once there's damage to the pipeline trench, there's all the delays covered, because that's what the policy says. Whereas there is a view, and I would hold this view, that you would only get the delay arising from the 5 kilometers of indemnifiable damage within the open trench warranty clause, and not any delay arising from the other 15 kilometers, which in my example were also damaged and not indemnifiable, because of the limit applied to the policy by way of that clause or warranty, similarly to the series loss clause.
Mm-hmm. Okay.
But it's not in the book. Sorry for that.
Now, I'm not sure if this one I'm going to read as part of an ongoing conversation or a new statement. Anyway, in general, the maintenance period of the CAR policy starts after handover by the contractor, since anticipated commercial operation date is the end date of the DSU cover. Is it possible that this date is laid after handover date? Most DSU clauses have handover date as end date of DSU cover.
Yeah, no, that's another good question. So first of all, let me say that those EAR-CAR policies that provide cover during the maintenance or defects liability period, the damage arising by its nature, damage arising during that period, which is covered by the policy, is not the subject of DSU claim, because within a day or so, or we'll come back to that in a second to refine that point. But it's you're no longer in the period of insurance for physical loss or damage, and you're into the indemnity period, or the business has commenced trading, and therefore there's no more exposure. So either the business started trading on time, and there's no claim, and the maintenance cover is running in parallel with the fire and fire perils cover, or there was a delay, and the DSU indemnity period is we're into indemnity period, and we're running the claim for DSU up until exhaustion of the period of the indemnity. So the policy needs to be explicitly clear as to the date on which the business is due to commence commercial operations, and that's why we say that there's so much ambiguity in policy wordings, not least the use of the word scheduled without talking about which schedule it's talking about, the policy schedule, the project schedule, and any other schedule. But the dates of practical completion, the issue of certificates, are one thing. We need to know when the business will start trading. That's the date that matters for DSU underwriting, and there can be an overlap between when the contractor hands over the keys to the recently built plant to the owner and the owner starting to trade. Optimally, it'll be at the same time, but we need to be clear in our policy definitions that we are talking about the anticipated date of the commencement of commercial operations, and no other date, which may be just before that or indeed after it. I mean, certificates can be late in being signed, certificates of takeover, and they can be applied retrospectively. That doesn't really impact on the DSU trigger date. Stephen, do you want to add to that?
Not particularly, Stephen. I think you've covered everything I would have said anyway. So yeah, nothing to add.
Okay, this is about debt again. If capital repayment is considered to be part of debt service, we would welcome your perspective as to whether insurers are in fact double indemnifying the insured, having paid the PD claim.
Yes and no. I said it would, the instances we've seen where capital is exceptional, where capital was indemnified under the DSU policy as an item is not part of debt service. Debt service is a fixed cost, but there have been instances where insurers have been willing, rightly or wrongly, to provide indemnity for the repayment of debt interfered, which wasn't normally possible out of earnings because the project was delayed and as a DSU claim, but not as a fixed expense, as a specific item on the schedule. So I'm not personally keen on the idea. I don't have any experience of pricing that type of risk, but I take the point. There is having paid for the property to be reinstated or repaired on the material damage side. So that's one thing that was put in the same financial position they were for the capital side of things. For the loan side of things, yes, there is a point. It's a good point that there is, on the face of it at least, a double indemnity being given here. But I wouldn't say that you bury capital repayments in the debt service or fixed expense item on the sum insured table. It would be a separate identifiable item, like we've seen some policies have extended to include, cost overrun or liquidated damages in some instances where some form of damages have been indemnifiable under a material damage policy. It's a fair point, but and we do raise that in the book, but it's not commonplace, and I think the market generally, the one I'm familiar with anyway, would push back on providing any more than interest repayments during the indemnity period as a fixed cost item.
Thanks. Another one. Hi, Stephen. Do you agree that determining the BFCOD is only as good as the underlying data you receive? Are there any additional provisions or practices you would like to see underwriters adopt that would assist you in your job?
Yeah, I think I probably would agree. One of the biggest hurdles that we face, and I guess any claims adjustment will face, is the quality of the data that you receive will determine how much progress and how much subjectivity and the number of assumptions that will need to be made when trying to verify the loss. In terms of provisions we'd like underwriters to adopt, project monitoring, pre-loss project monitoring is something that as a firm we've pushed for a number of years, and we do see a lot of benefit there. With bringing a bit more transparency to progress of the project, to having a mutual understanding of the sort of documentation and the records that will need to be kept and shared. I think on top of that, maybe outlining at the onset of the policy being placed, having an understanding with the broker and the insured, the policyholder, the information that will be required. I think what most professionals will try to do is work within the project records that are likely to have been maintained and kept anyway, so it shouldn't create any additional burden on the project team. But I think really the more transparency there is around the documentation that can be and is needed to be provided, and maybe the timing of the provision of that documentation, will go a long way to helping us be more successful in determining the but-for COD, and then ultimately being able to verify delay as a result of damage or an insured event.
Okay, thanks. We have quite a few more questions. I don't know, and we have 166 people still on board. So shall I still go, guys?
Yeah, I think so, Stephanie. With
Okay.
for not indefinitely, because it is now 2 hours or so we've been on this. You carry on with questions, and we'll draw a line under them at some point, and we can follow up with these some other time. But I think at some point we have to stop. But please carry on with a few more questions.
Okay. ICOW versus additional ICOW. What is the basic difference for the layman?
Yeah. So ICOW is something extra. It is. The question is, does it go beyond strict indemnity? It's not necessarily spending $1 to save $2. It normally has its own sum insured, much lower than the potential full sum insured, and it is to pay for extra expense. This arises under BI insurance as well as DSU to bring the business back into the same footing it would have been. So extra marketing, press release, damage limitation, trying to retain customer loyalty, those sort of expenses which are insured separately as a item on the policy schedule, rated separately, but it's not in the same concept as spending $1 to save $2. It's meeting the costs of trying to mitigate or hedge the effects of there being a delay. Again, you could spend money on a ICOW and not get any benefit from it, and again, it's money spent and you can't recover it. So if you have a delay expected and you make a campaign, advertising campaign or media campaign or whatever you do to try and mitigate the impact of that, there's no guarantee, given that this loss will actually arise in the future, of it being successful. I hope that answers the question.
Thanks. Next one. Is it correct to ensure net profit in mining project? There is without doubt an exposure of a delayed debt and fixed costs. However, the net profit is only delayed as the amount of ore in the mine stays the same, and an eventual indemnity may constitute an increase of revenues / profit along the mine lifetime.
Yeah, that's a great question. Again, I don't have the answer. We in our book we talk about different industries and their revenue streams. So, and I'm scratching my head, and I won't attempt to reach across and look at my copy. But whether we actually address, I have no experience myself in insuring mines at all. So I'm not the person to answer that question. I don't like mines. I never did like construction of mine risks, but I take the point that the ore is still in the ground. It's just a question of when you get it out. Similarly for oil, it's still in the ground, and what are you paying for? It may even increase in value in the future, arising from a delay. But I don't know. I don't think we addressed mining per se in addressing various industries. So I can't offer a. I take the point, and I think it's a well-made point, and I would repeat, unless it's expressly insured separately, this would breach the principles of indemnity. In other words, putting the insured in the same financial position as he would have been had the incident not occurred.
Okay, thank you. Next one. It is easy to understand DSU for the manufacturing risk, and it is the coverage for the lost money due to insured cause. What happens in real estate when, due to delay, there are no buyers who could potentially buy the property, or there are no tenants who could potentially rent the property?
Yeah, so loss of rent is a typical basis of insurance for commercial property. So that's their revenue is the owner, landlord, builds a building and in the expectation of renting it out to tenants who are going to pay him a rent each month or each year. And if there's a delay, he's not going to receive that rent, and that's the subject of a claim. But there has to be tenants. He has to have tenants on the hook, as it were, or signed up before he would be indemnified. If he's speculative and builds a building in the hope of finding tenants, he would have to prove that the delay to the completion of the building denied him those tenants. If it's not, he wouldn't have suffered a loss that's indemnifiable.
Okay, thank you. Next one from Josh. Touching on your response and warning regarding standalone DSU policies, Do you foresee the same issue on a policy ensuring CAR and DSU plus a first loss limit on an existing structure? In this scenario, the property insurer would provide PD cover for the existing structure in excess of the limit. This is becoming more common with the influx of building redevelopment projects.
Yeah, no, that's yeah. I would. So my approach would be slightly different to that. I would, if I'm insuring a building development with retained structures, like a retained facade or Victorian building retained facade, and you incorporate it into the new works, I would want to see that covered under the material damage covered under the CAR policy, not insured separately under a property policy. I would. That's where I would take that path, and in so doing, I would be willing to include as it had been constructed during the policy period of insurance, damage to the works and the retained facade or retained structure, and provide DSU cover for the resultant delay for that insured damage. So I wouldn't. That would be my approach. We haven't catered for that in the book. I recognise exactly what's being described here, but I would incorporate into the contract works policy the retained facade, albeit with a first loss limit, and would say that limit applies to the material damage, and the delay to reconstruct it, if that's possible or as best you can, would be within the indemnity period for the DSU, and the underwriters working out the premium rate for that risk would recognise the difference between the new build and the pre-existing, which would be quite expensive and time-consuming to reconstruct. There's an underwriting matter, in my view.
Thank you. Could we touch on the options insurers can provide at the time of an EAR extension request in instances where damages has occurred, but it's not yet known if delay and reinstatement will be required?
Yeah, the choice is simple. You either stick with the anticipated date of commencement of business, and that triggers your claim when that date is missed, or you say, this delay is potentially only a very short one, and I don't want to use that up as my trigger date. So I'm going to this is insured speaking. I'm going to say I'm going to extend both the EAR policy, CAR policy, and move out in time a corresponding date for the new anticipated date of commercial startup. So you're foregoing the possibility of claiming the difference between those two dates. And if a more serious claim occurs later on, then you're going to have full indemnity period available to you for that. Whereas if you stick to your date, so EAR-CR policy is extended, but the DSU period of insurance is not extended, and therefore you're going to stay with the original delay date, then you're no longer in the period of insurance, but you're into the period of indemnity, and there's no further cover during that period of indemnity for new unrelated causes of loss or damage. That's the trade-off. You either extend the policy period and forego any potential claim you have. It's quite straightforward, I think. It's as though it was a general delay, or you preserve the single date of anticipated startup and run with that. And then if you have another claim later outside the period of insurance, you're not insured unless you've reinstated and paid another premium for the new indemnity period and a new deductible.
Thanks. Another one. Hi, Stephen. You've already touched on this subject. I wonder what impact would have Leg 3/DE5 extension for a specified limit for a defected part in terms of DSU, considering that with Leg 2, lost damage would not be indemnable. Many thanks.
Yeah, okay, that's a good question. So to what extent do policy sublimits apply to both sections? That's a matter of policy drafting, and I've used that example of Leg 3 cover, which essentially says that on the one hand, defects themselves aren't insured, everybody agrees with that. But once damage occurs, then the only thing that's not indemnifiable is the cost of betterment. That's essentially what leg 3 or DE5 says. So, but in giving that wide, there's a very big difference between leg 2 and leg 3, and huge difference between DE3 and DE5. But not to dwell on that, but there's a potentially big difference between those two exclusions. And in providing the wider cover, the limited exclusion of DE5 or leg 3, some underwriters apply a sublimit to the amount of payment they'll make for that part of the claim, the part that would be excluded under leg 2, in other words. And I think that limit applies, and it should be said so in the policy, that limit applies to both the PD and the DSU claim. You can't have, partial indemnity by limit and have full indemnity for the delay. However, there is an opposing view to that, and it's dealt with in that chapter in the book. It talks about qualified policy exclusions. Bear in mind, these are exclusions; they're not extensions to cover. These defects are exclusions, and it's what's excluded that matters. And what's excluded from the PD claim is excluded from the DSU claim, whether by exclusion or by limit, in my view.
Okay, thanks. I'm interested in how...
Sorry, just to say, if there's an earthquake limit on the policy, for example, so I've seen some policies in earthquake-prone areas where there'll be a limit, sub-limit, which everybody accepts. The banks even accept that there's a limit of $50 million on a $200 million project for earthquake. And again, that shouldn't be in the policy as a sub-limit to the PD section of the policy. It should be a sub-limit to the whole of the policy, including DSU.
Okay, thank you. Next one. I'm interested in how expediting expenses crosses over with DSU. Could you comment?
Yeah, expediting expenses are paid to a contractor to keep him back on track, help him get back on track, to pay overtime. It is an overlap between that cover given to the contractor, and normally it's an extension to the CAR-EAR material damage policy, but that's the benefit of the contractor rather than the owner. So there is an overlap in cover, but they're not the same thing. I hope that answers the question.
Okay, thanks. I've got quite a long one here. What is your practical advice if you would have a CPI-like cover, in brackets, not just one-to-one Munich Re, for EAR, car, cargo, and DSU regarding the proper definition of the indemnity period? My point. To my view, there should be clearly two separate IPs for each cover, marine cargo DSU and for E/car DSU, having a common PAC as IP start date. But sometimes there is no adequate wording clarity, as it appears to be only one single IP for both underlying coverages. So, for example, a significant marine DSU loss could, eating up already, have a huge portion of the overall IP without no IP left for a possible delay causes by C/EAR loss.
Yeah, no, this is a long question and it's a complicated one, but I think I understand it just a bit. There are some, and it's not exclusively Munich Re, but there are some that were in the past, maybe it's returning, package policies where you've got multi-section cover, and the question is asking whether it's preferable to have separate indemnity periods attributable to each section of cover. So section 1 cargo, section 2 EAR, CAR, and even section 3 operational or risks and its own indemnity period. I can see it both ways. The thing about marine cargo is the cargo can be delivered any time during the construction period. It doesn't all arrive at the beginning and then sit there waiting to be incorporated into the works. So, but it's the same business that's going to be impacted by the delay in its commencement, whether it's attributable to a marine loss, in year 1, or EAR/CAR testing loss in year 8. And as I say, the cargo risk is continuous, because things will be delivered to site just in time, or at some appropriate time, when it's needed. And so there's a continual arrival on site of cargo, and the potential for any one of them to be delayed. So I'm of the view, I sympathise with the point that there should be a separate recognition of a separate exposure, and indeed it may be a shorter indemnity period for cargo than there is for the EAR/CAR. But I can equally see that there's just one business that's going to be delayed on one date, however arising, and as long as your indemnity period is long enough to take care of all of it, whether it's a combination of cargo delay and EAR/CAR delay, or just the delay from cargo, or just the delay from CAR, is another matter. That's the attraction of a package policy, that you get economy of scale, you get ease of administration, and you get no gaps between which cover can fall, between this interface between cargo and EAR, or interface between EAR and operational or risks. And in the book we do discuss and give out some wordings on how to share indemnity period and how to share the deductible, which is I'm not sure the questioner asks about deductible, but it's equally important to know who bears what part of the deductible when you've got a combined cargo and EAR/CAR delay. But
I think if I can just add to that, I guess from a practical point of view, Stu, I'm not saying yours wasn't practical, from a delay point of view, maybe. The difficulty, I'd say, of having the sort of back-to-back indemnity periods for cargo and CAR, EAR, is to make sure that you can aggregate the losses in that to that degree. If you said had a 1-year indemnity period for both, and cargo uses up its year, and then you have a CAR, EAR event, it's where do you start measuring that from? DSU is always about the additional delay. So therefore, the new sort of but-for COD under the cargo indemnity period become the de facto anticipated COD date for the CAR, EAR policy. So there'd be a few difficulties and wranglings across there in terms of being able to aggregate those two delay events effectively.
Yeah. But the idea of running out of cover shouldn't arise, because as I said, the insured chooses the indemnity period at the beginning, and he should foresee, or be willing to foresee, the worst of both worlds, where big delay in cargo and a subsequent big delay in EAR, and he needs to make sure his business interruption stemming from those two insured events, insured separately or under one package policy, is sufficient to cover the last day of his loss. I mean, that's.
So you want to have a conversation with Crossrail or HS2, Stephen, I suppose.
Okay.
Okay. Looks like we've got one more question, and we have had loads and loads of thank yous of very grateful people. But I'll read out the last one from Rob. What if project is fast-tracked and anticipated date of completion is now sooner than previously planned, and then it sustains an MD loss? Sorry, as I was reading it, people were typing in answers and it's popped out of my view.
Yeah, no, I understand the question. You said enough of the question, Steffi. I mean, exactly what he's asking. So early completion is not indemnifiable under the DSU. The DSU date is set, and allowance is made for the float or the slack, as we discussed earlier. And if the contractor takes expedited measures or shortcuts, or does things in an accelerated way, for which he'll be rewarded, of course, it's a bonus for him if he finishes early normally. Earlier than anticipated start date would not count as the beginning of the indemnity period. And there's a real case on this. I forget the name of it. It was in Connecticut in the US about 10 years ago, 12 years ago, maybe, time flies, where just that thing happened. And there was a catastrophic fate, including fatalities, on a contractor that was said to be 9 months ahead of schedule, and a catastrophic explosion occurred, killing people, and when the claim was launched, they wanted their claim to be paid from the date 9 months earlier than they said they would be starting their business, and they failed in that claim. The claim would only run from the anticipated date of completion. That date can be changed by agreement, but rarely would I expect an underwriter to agree to turn the clocks back rather than turn them forward, because the underwriting has taken into account the fact that there is an opportunity in any business interruption claim to mitigate and avoid the loss. It's not a straight line curve of loss, and if you bring the date forward after underwriting, you're changing the dynamics and changing the exposure, and you're changing the risk. So that's my answer to that. And we discussed that in the book, about how to change the date and formalize that with formal agreement. Not just we're running 9 months earlier than we thought, we're claiming now rather than 9 months time. It doesn't wash. If the policy is clear about the date of anticipated commencement of commercial operations.
Okay, I think you sent another question following on from that. And then would you like to call it a day, Stephen, after this next one?
Yes, I think so.
Okay.
I think it's reasonable. It's 1:30. We've been going for an hour, 2.5 hours. I think it's reasonable.
I know, and we've still got just over 100 people, which is great. Okay, last one. If project has a fire and damages equipment, A, which causes 6 months. Sorry, I'll start again. If project has a fire and damages equipment A, which causes 6 month delay. However, while the fabricator is manufacturing equipment A, again, they sustain an EQ loss that delays the project another 6 months. But EQ is excluded in the EAR policy. Are we paying DSU for 12 months or 6 months?
It depends whether Stephen will answer this as well, but it depends whether the 6 months are concurrent or sequential. The exclusion of earthquake cover would and the amount of delay stemming from the cause of earthquake, which is excluded, would not be part of a DSU claim. And if it's concurrent with the damage to the insured property, which is being refabricated during that 6 months, if that is concurrent with the delay caused by the earthquake, then there's no cover. However, if despite the earthquake excluded, the project was still late because of the fabricated property damage, then it would be, as Stephen illustrated, would be an indemnifiable claim. But the coincidence of insured loss and an excluded loss, the excluded loss takes precedence.
I'd agree with that. I think, Stephen, you've clearly got a future career as a delay analyst ahead of you.
Well, okay, so Stephanie, I think that probably is time to call a halt to it. If you're happy.
Yes, that's fine. I don't know if Marina wants to say anything, but lots of people have sent in lots of thank yous to both of you. So thanks.
Okay,
Here's Marina.
Yeah, I would like also to thank you very much. It was a wonderful webinar. We have so many people here. And thank you both for these wonderful explanations and this great Q&A session.
Okay, good. Well, it's I speak for Stephen and myself. I think it's our pleasure. We're passionate about this subject. We gave up quite a lot of our time to write the book, and the more people that show interest in it, and these questions were on point. These show a level of understanding and appreciation of the complexity of it in themselves. The questions show there's an encouraging level of understanding and interest out there around the globe that is very pleasing for those that wrote the book, because our time was well spent.
So thanks
again. Well.
Yeah, thanks again, and I wish you a very nice evening.
Okay. Cheerio.
Thanks, everybody.
Bye. Thanks, Stephen. Cheers.
Everybody,
Thanks,
bye-bye.
Marina. Thanks, Stephanie, and everybody else. Thank you.